Welcome to the Money Panda, hosted by Elvis Kolawole.
Hello, everyone. Hello. I'm so excited today on this very episode of Money Panda. We're going to talk about a really insightful topic today. Today, I have Mr. Dima Foremnyi, and he's a general partner at 3X Capital, which is a seed investing VC firm that, of course, specializes in the Web3 space. And today, he's going to give us an ultimate crash course on Web3 startup investing. And it's going to be, more or less startup investment one-on-one sort of session. And it's going to be a little different from our usual episodes. And of course, I imagine this is going to be really helpful for lots of the founders out there and people who are looking to assess investments within the Web3 industry. Before we go forward, Mr. Dima, how about you tell us a little bit about yourself, a little bit about 3X investments, whether you only invest in startups you expect to go 3X, or, the sorts of investments you tend to go for, what you're all about, and what you're looking to do within this episode.
Yeah, thanks a lot, Elvis. Hi, everybody. Really appreciate having me. Thanks a lot. So yeah, in short, my name is Dima. I used to be a lawyer, so I have a legal background. So I will also elaborate a little bit on some, legal points. But of course, it's not going to be a legal advice. You should consult your lawyer. But some insightful things from legal background I'll share for sure. So I used to be a lawyer back in Ukraine, where I'm from. Then I moved to the Netherlands. That is my, let's say, second home country, where I also worked at Booking.com at a law firm, and I was dealing a lot with startups, and I was fascinated by this sphere, and I at some point decided that being a lawyer is not so fun. I don't know if any of you are lawyers, but it's not so fun dealing with documents all the time. So I decided, okay, I want to go to something more entrepreneurial, right? So I think a lot of you also feel like that, okay? Like I want to do something, I want to create something, I want to help creating something. So that was my feeling, and I decided to start a business accelerator. So I did a franchise of Dutch Business Accelerator. I took the franchise and I started building it. And gradually, during 5 years, I've helped so many startups. We did incubation acceleration programs. We did hackathons, demo days. So there was so many things about startups. I managed to help more than 100 startups to raise money, build their decks, build their business models, build stronger teams, this kind of thing. So that was super exciting for me. And at some point in 2020, I've applied for the exchange program organized by the US government. So what they're doing, they're taking a group of entrepreneurs, like 20 people, they flew them to the US. So they flew a group of entrepreneurs to the US to get to know the ecosystem. So we went to Washington, Austin, LA, San Diego, met a lot of different investors, get to learn a lot of things. And then during this trip, I've actually met my current partners at 3X Capital. We have three co-general partners here. My partner, Ivan, he's a very sporty guy. So all of us really like sports. So that was one of the things that helped to build the team. So we do jokes, runs quite often together. And Ivan also had a legal background, but early on he started to be an entrepreneur, and he managed portfolio of crypto funds in Asia. So he's really involved in 16. And Taras, the third co-founder, he's a serial entrepreneur. He lived in Poland for quite a long time. And then he started multiple businesses. And the last business he sold, that was IT outsourcing company. And then we met and we decided, okay, let's work together. We have different backgrounds, a little bit of legal, a little bit of startups, a little bit of entrepreneurship. We all like Web3 and crypto. So let's do something together. We wanted to invest. We had a little bit of capital that we would like to start with. And so that was our idea. So that's how we started. And now 3X Capital. So we started 3X Capital because it's three of us, right? So of course,
nice.
Returns of 3 and more X's, but
hopefully
the name is, yes, of course. Hopefully, if we invest here in the bear market, I think we may have the possibility to get 3 and more. But yeah, so we started 3x Capital, and early on we decided to hire analysts that would be helping us to analyze startups. And it's quite hard thing, especially in Web3, because it's similar to the regular startups, but in many ways it's also different. The approaches to investing, how to analyze startups, so many different things. And analysts didn't know how to do that. So what we did internal education for them for about 2 months. And we hired one person, and then we hired another one. So we took like 10 interns, and then one of them were hired, and then the other one was hired. And then one of them said, hey, such a great program. Why don't you do it as a separate thing? So now we have a separate educational program that started as an internal program for our analysts, and now we have it as a separate thing for founders. So for founders, I really like to help founders in a way to understand the thinking of the investor, right? Because what happens with startup, they send the pitch deck to investor, and then some magic happens. So they send their deck into the black box, let's say. Some magic happens, and then you get a response. But what happens in the head of the investor? How do they assess? What do they look at, etc.? It's crucial. So you could reverse engineer and improve your deck, your startup, your approach. So I think it's crucial. So that's one of the things that we are here to help with. It can also help investors to analyze more, let's say, structured. Because I know myself, like if you like a startup, you're thinking, okay, I really like this founder, I will invest in them, but you don't know, what are the business model intricacies, what is the founding team, what is the tokenomics, what did they do together? So you have to take into account so many things, and early on investors don't understand that, and we would like to help them to make better decisions. So that's another thing. But also a lot of people are just very fond of Web3, and they would like to switch from their regular job. You're an analyst, for example, in the bank, like to work in an accelerator or an investment fund in Web3, right? You really think this is the future, but how do you switch? How do you understand Web3 startups? Like those kind of things we were discussing internally, and then made it as a separate program. So we are now investing as a syndicate and launching a fund, a 50 million fund to invest in Web3 startups.
Wow.
That's a 10-year fund to support the most prominent startups from all over the world. We're not going to have any geography to focus on, but we will focus more on the infrastructure, on DeFi projects that are out there. So this is what we're doing, what we're building. We are also testing a lot of technologies, in order to understand what's working, what's not. We are building some internal products. We also have a few people who are programming, so a few developers that work with us. Also looking for AI kind of solutions that help to make better decisions. And actually, during the course, we also discuss how you can use AI to analyze startups, to scout startups. That's also like a fascinating thing that just happened, right? It was never before that you could use AI to find a startup, to analyze startups. So this is something really, really new, something really interesting that we're fond of. So that's in short about 3x Capital, about me. On personal side, I have 2 kids, 5 and 2 daughters. They just went to school. Having a little bit more of management, how to pick them up, etc. But so far we're based in Lisbon. Great. Well, that's in short about me, about 3x Capital.
Thank you so much. That's wow, it's a fascinating story, learning how 3 friends became 3x, and now, you're looking forward to, sharing a program that began as an internal thing. You're actually like sharing your resources, you're sharing the knowledge, and you're sharing all of that to people way beyond your internal network. And that's beautiful. Like that's a sort of building that we need, in the Web3 industry to actually like empower more and more people to actually have better perspective, and
Sure.
that brings me to the meat of what we're here to talk about. So for me, the way I understand, investment in the Web3 space, and the way most other people could think about investing whenever they do a bit of a Google search, is that it's kind of like divided into equity and token investments, right? And usually I would say, I have a small, maybe some sort of a rough understanding of what that's like, based off of what people in Web2 do. But I'd like to hear your expert opinion. Like what are actually like equity investments, especially in the Web3 context? How do they tend to actually work?
Yeah, thanks, Elvis. I think that is a good question and a relevant question, both for startup founders, but also for early stage investors, like angel investors who would like to invest some money that they already earned. They would like to build the ecosystem, help them some startups to get off the ground. And that's what people are thinking about in the startup, especially in the Web3 environment, right? And indeed, in regular startups, we have equity investment. But in Web3, we also can invest in tokens. And this is something different and new, so it adds a specific dynamics. And the interesting thing, now you have to, as an investor, as founder, you have to think, okay, so we have equity and we have tokens. How do we raise money? How do we use those wisely, and it actually was changing from previous times towards now and towards the future. We see some trends how people are raising money. So when Web3 just started, I don't know, maybe we're not going to go too long, but 5, 7, 10 years ago, when I started in 2016, 17, when I started with Web3, with crypto, people were raising money in ICOs just on their websites, just with tokens.
Yeah.
And it was a crazy times. You could have invested like just through the website, just send your ETH or something, and then you would expect something. But a lot of times, most of the times, nothing happened, and you just were dumping your investments. So people were frustrated with that, and of course, regulators were frustrated because investors were frustrated. So over time, a little bit, things changed a little bit, and now you have more and more regulations that are saying that you should not raise in tokens directly and saying, hey, this is a token investment, specifically in some jurisdictions like the US, because if you do that, they immediately say, hey, you're doing equity proposals and you should not be doing that without registration, right? So now it's a little bit more complicated how to work with tokens. So probably now you would shift, and we see startups shifting towards fundraising both with equity and tokens. And I think now is quite interesting both for startups and for investors. So for equity, so you can now raise with equity, meaning that we say equity bond, but in most of the cases on early stage, on pre-seed stage and seed stage, a lot of times there's not an actual equity, but a promise of the equity in the future. And there is a great, it's a convertible instrument that allows you to save some time and save some money on lawyers, and that is called safe agreement. So it's a simple agreement for future equity. The acronym is SAFE. It was developed by the Y Combinator, and they understood the startups really lack, especially in the very early days, illegal understanding of how the things are working, and it's hard to find a lawyer or to hire a lawyer. So they developed this document that actually allows you to get some money in and make a promise that in the future rounds, when we develop a thing, we will have a price round and we will issue equity and we will distribute it to you. So this is the most simple instrument that is now used in startups and specifically in Web3. So now on the seed stage, 95% of startups are raising through SAFE agreement. So this is an agreement that allows you quite quickly. You go to Y Combinator website, you download SAFE agreement, and that's it. You can send it to your investment, and you don't need to issue shares at this moment, but you can do it in the future.
Wow. I'm actually just learning this, that it's more like a promise. Like how, for example, like money began as promissory notes that, oh, I'm going to give you some gold in the future or something like that. So this is something like that, except that it's just for equity. Is that what you're trying to say? I actually never thought about this. This is actually the actual first time I'm knowing that, oh, this is actually how it works legally. Huh. Okay,
So a lot of people don't think about it, but you see now you have some insights that you actually don't have to give away your equity at the beginning, and you have a free standard agreement that you can use that is out there on the internet, on the YC Combinator website, that makes your life much easier as a founder to go and fundraise. And this is standard already, like for 10 years probably. It is a standard for fundraising in many countries, basically all over the world. So you can utilize that.
Nice. Okay.
And so now we're getting, we see these dynamics between equity and tokens, right? And nowadays, the most often approach that we see is equity and plus tokens. So that's actually what we like. And as for the tokens, it's all not so simple, because a lot of startups in the seed stage, they don't have the token yet, right? But they think, okay, we will build this platform, we will have the token for this kind of utility, but it's not there yet, right? So how do you actually sell that if you don't have it? And in this case, you actually also have a specific legal agreement that is called SAFT, similar to SAFE, but it's a simple agreement for future tokens, or it could be a token warrant. So this is also a convertible instrument saying that, hey, if you invest in our startup in our equity through SAFE, for example, then in the future, when we will have the token, you will have like some amount of tokens either for free or with 90% or 50% discount.
Wait.
This is another.
Wait,
Yeah,
so you're basically telling me that that there's an agreement that is basically a promise to get a promise of equity. Is that what you're basically saying?
yeah, exactly. So you're just basically selling a lot of promises to investors, and that's how it works. Because it's
Wow.
easier, and that's interesting thing that this dynamic it emerged when investors understood that, okay, of course investors have money to hire lawyers, but startups don't. And it takes a lot of time, and you really want to invest fast, and you don't want to spend a lot of money on lawyers. And anyway, 90% of startups would probably fail. Like, okay, 50% would fail, maybe 40% would do okay, and less than 10% will do really, really good. So it doesn't make sense to make really complicated legal agreements in the very beginning. It just doesn't make sense money-wise and time-wise. So that's why okay, I see the great startup, I see great founders, and we have these legal frameworks that have the promises, like promise of equity in the future, promise of token in the future. You have your deck. You have a team who is dedicated to work on it. You would need to have a specific plan, tokenomics developed. That's all what we also discussed on the course, and all the things like financial plan, P&L, etc. So it should be there. But essentially, you're just selling your idea and the promise of equity and tokens in the future. So that is really interesting.
Wow.
Insight, I think, for founders.
Wow, the layer of promises upon promises is really, I would say that's interesting to say the least. So Dima, something interesting you said is the fact that, the SAFEs, like the SAFE agreement, was actually popularized by Y Combinator, and I found that like really interesting and like really quite the model that a lot of founders and startups are already using. And I'm not quite sure whether it's the same scenario as the SAFT, but first things first, like with equity investments, like what are the pros and what are the cons that a typical founder should look out for an SAFE investment or an equity type investment, especially in the context of Web3?
Mm-hmm. Yeah. Okay, that is a good question. Thanks. Indeed. So we have SAFE and we have SAFT, right? So SAFE would be for the equity or for future equity, as we discussed, right? The promise of the equity, and SAFT for promise of the tokens. So I can name just a few. We'll discuss it more during the course. But pros for investing in equity, at least from the investor point of view, right? Because I'm an investor, I'll share some my thinking, so you get into my head a little bit, so you understand me better. I think this is also helpful to shift the perspective. So pros from my perspective is when you invest in equity, you get more control over the startup. I mean, in later stages, if you would be investing in equity, usually you would get some board seats. You would be on an advisory board. You would be contacting with the team regularly. Having quite close interaction, especially if you're an early investor. Making some suggestions. Guiding sometimes. So this is for those investors who would like to be more a little bit hands-on. And really follow what is going on with the startup. If they're on the right track, can I help them with something like and of course it comes with a little bit of control. Let's say on later stages with board seat, you can have direct control, right? You can vote for some things, you can ban some things. But also, if you invest in equity, you have more predictability because there is already enough regulation and protection for investors in the venture capital sphere. It's been developing throughout the last few decades, and we have quite a lot of legislation in each country, so they are country specific. But there is also enough court cases, that drive you, that can make sure that investors are protected, that it's not only the promise, but it's also promise that is legally binding, right? So you have some responsibilities, etc. And if something went wrong, you can, as an investor, you can protect your rights and protect your investments. So this are definitely the pros of investing in equity. So getting more control, getting more confidence about the regulations and how it's gonna end up. Of course, there are some downsides. Or I don't know, maybe you have any
I mean, tell me
the
about the
pros.
downsides, because I mean, like you said, you talked about the fact that like lots of investors who want a bit more control tend to go for equity, but then of course with more control comes a bit more responsibility. At least at the top of my head, like it feels like that's a downside already, but perhaps that's not quite the goal of every investor. So what, for example, if I was a founder, like what would be, downside to like giving equity, especially like using an SAFE or a safe agreement.
Yeah. So the idea of ownership comes in here. So once you give away equity or promise to give away equity, you start to dilute your own portion of the company, right? So the ultimate thing is you want to make sure that on the Series A or Series B, you have enough voting power to be in charge of your startup. Because sometimes it happens that startups are raising money and they are very generous, about giving away equity. Okay, I'm gonna give you. You're my friend. I'm gonna give you like 20% or something, then 10%, and then all of a sudden, on the next round, when you have to raise again, you don't have any ownership, or you have such a small portion of ownership, like 20%, that it's not interesting anymore, because you also have 20% of revenue, right? So equity, it also equals potential profit of the company. So if you only own 20% of the company and you don't have enough to say in the company anymore, and you don't have enough profit compared to other previous investors, so it doesn't motivate you. So it also could be a downside, the dilution part. So startup founders should be aware of this process of dilution of the equity on the token side. Sorry, just give me a second. Get some fresh air. So that's the downside of equity, which actually doesn't exist on tokens. Right? So that's why tokens were so popular as a fundraising mechanism earlier. It's not fundraising per se mechanism anymore, but it was very popular because you could raise money, and without, you wouldn't be given away the equity, the ownership of the company. So that's where tokens came very handy. Let's finish with equity first. So the downsides for the investor could be that equity actually takes a lot of time to exit from. So as an investor, I would like to support promising startup, and in few years, I would like to get my money back with some extra percent, right? Because I took the risk of investing into that company, and usually it is between 4 or 5 years, up to 10 years before I can get my money back. So that's quite a lot of time. And of course, it is less liquid in terms of exit events. So when can I sell my shares or potential shares? So that would be the next round of investment, which could be a couple of years from now. That could be a merger or acquisition, and that could be an IPO. Right. So as for the next round of investment, usually there is not enough upside, so you kind of wait a little bit longer. Then the merger may come or may not, the IPO may come or may not. It's not so certain. So these are the downsides for the equity investment in startups. But now we have tokens. Okay, this is something else, something really specific for Web3, and startups have been utilizing tokens before for fundraising purposes, right? And the thing is, if an investor invests in tokens or promise of the token through a SAFT agreement or token warrant, we can talk about the differences between SAFT, simple agreement for future tokens, and token warrant separately. But if an investor invests in tokens, he or she is also locked for some period because you have tokenomics, which usually have a vesting period. You have cliff, and you have the unlock period. So it's also not so liquid, but usually the tokenomics and the unlock for investors is between 3 and 5 years. So it is, and it is gradually unlocking. So you're getting bit by bit your tokens, right? So you can exit if you like to, bit by bit. So it's kind of already on the positive side. So potentially you can also get a higher upside, right? It was not uncommon to have more than 100 access for top tokens for the top products on the market. But of course, it's a separate business. They should make sure that the token is treated well. So treating your startup and your product is one thing, but treating your token is another thing. And you should have enough capable people to be able to deal with token. You should have a good market maker that would be dealing with price of the token on the market. So and the funny thing is that often it doesn't correlate. So the product may perform well, and the token may go down, right? And so there is no direct correlation like with stocks. And it could be the opposite. The token may go up because market maker is making good moves, and then the product is failing or something. So that's another thing. But potentially there is higher upside even for tokens. Another pro is you can choose if you want to invest in token or not. So you may have the setup where a startup invests in equity, and then the startup says to the investor, hey, you have a right, not the obligation, but the right to invest in tokens in the future. And this is a token warrant, right? This is a document that allows investor in the future to invest. And for me as an investor, that's a positive thing. So if I see the product performing well, I see the team is good enough, they can make sure that the token will grow. You have enough utility developed. And in this case, I would like to invest in token. Why not? So that's another positive side. And of course, for founders, it's the ability to have more liquidity without getting your equity away. Right? So your ownership of the company from the first days you created, you should be very aware with and calculate in the future. That's what we also discussed in more details. Like dilution, a lot of people are not aware of that, but dilution is thing that may happen like this, and all of a sudden you don't have a company anymore. And with tokens, of course, there are some downsides. Right? You have less regulations. There is higher risk and more volatility for sure. And it's not an equity where you have voting rights or something. You don't have any control over the startup. You may have some voting rights if there is such a utility of the token, but usually there is not too much going on with the token if you're an investor. So those are like few things that I would like to highlight. These are kind of different things. Oh, you're muted, Alex.
Oh, sorry. So I think I might also want to add the fact that usually like what causes the market volatility like for tokens is the fact that there's usually like of course like exposure to market forces, which is not usually the best. I think markets are not always like very rational, and you're always like exposed to all of that, and the asset is really volatile, a bit more risky. But I think, like you said, something worth considering is the fact that the exits, like they're very clear exits much sooner, which is something that might benefit both the investor, maybe sometimes even the founders, especially, if perhaps maybe the sale of the token might not necessarily correlate with the performance of the business, like you said.
Yeah.
So yeah, that's good. So you spoke about like a couple of types of a couple of types of token investments. And okay, could you quickly just go over like the major types of token investments that people do, so that perhaps people know what their options look like if they wanted to do that. Like just real quick. Yeah.
Okay, I'll try to. The thing is, so there is a startup and it has tokens. So you can go to CoinMarketCap and see there are so many tokens, right? But you should also be aware that these are liquid tokens that are already on the market.
Yeah.
And when we're talking about venture investment, we're talking about tokens that are not on the market yet. Right? So there are a lot of projects like I don't know, layer 0, for example, one of the top protocols, infrastructure protocols of the Stargate. It's already working, but they kind of not saying if they have a token or not. But some investors, when you invest, you already can get a token warranty in this situation. So it gives you the understanding that in the future there might be a token. So this is some to consider. So we are now talking about early stage investment, right? Not talking about the on the market investment, but early stage. Mm-hmm. Yeah, not late stage tokens, but early stage tokens. And in this case, you could invest as a private investor through soft, through token warrants. So there are two ways how you can do that, and you can divide them based on a few things that are important. That's basically about the instrument itself, the timing, the obligation, the risk, and the potential upside. So for soft, it is basically a contract promising future tokens, right? But token warrant is a right to buy a token at a future date at a specific price. So these are different things. At soft, you're already making payments. Hey, you're making the payment now, and you get the possibility to get a token in the future. With token warrant, it's more flexible, so you can opt in to have the purchase in the future. It's the difference also is with timing. So when do you get the tokens? For soft, you usually get tokens when they get live on the network. So when you get the listing, you get them on different exchanges, and then usually this is also the time when you can first get the tokens in, or at least some portion of the tokens according to tokenomics. With token board, it can be exercised in the future. So this is something different. It's not exactly at that specific moment of token generation event.
Nice. Okay.
So it's also about obligations, and obligations. So for soft, you already pay for tokens upfront, and in token warrant in the future, you would need to pay in the future. So this is also very important, right? If you're investing, if you're giving away your money now or in the future. So this is something also you invest. You promise your tokens, but investor promises to invest in the future. So it is promise against promise, and you can see that it is. So many things are relying on trust and credibility of the startup, credibility of the team. Like you make promises and you make your best efforts to do that, and that's basically what those contracts are about. They're just outlining those promises and that you have these good intentions to build these kind of things. And the last thing maybe that I mentioned is the risk. For soft, the risk is that the project will fail and there will be no token at all. It will happen. And for token warrant, the risk is different. It's about that the token price will not exceed the warrant exercise price. So that would be the price where you can actually buy the tokens. This is another risk that you take. But those are some very specific into detail things. If you're curious, I can talk about it much more, of course. But I'll stop for now.
Yeah, that sounds absolutely fascinating. And I think that so much of the structure is based off of its potential performance in the future. And potential activities that could happen in the future. So that's interesting. But I guess that's also what investment is really all about, like trying to forecast what could possibly happen in the health of the company in the future. So okay, so before we wrap up, just one more thing. I know this might be a throwaway question, but could you talk about perhaps just one investment and what's in your mind made it stand out from the rest, especially if indeed it was a token investment or an equity investment, and you don't need to mention the name of a company. You don't need to mention the name of a company. Just something that could perhaps show people why this was a really good investment, from your point of view as a VC, and why, it could have gone differently if it was different sorts of an investment.
Yeah, sure. A great question. I have something on my mind that I can share. I will not name the project, but we've done an investment in the past that had an interesting structure. So I mentioned to you that you can invest in equity, you can invest in tokens, and you can have both. And in this specific case, we had equity plus 2 token warrants. So that project, that sub-project that was already out there on the market, it has own token that is already being traded. And then they were thinking to start a new token that would be like an infrastructure token, and that would be a second token. So basically, we invested in equity and we got access to tokens that is already listed on the market, so that are liquid, and we got the possibility to get extra tokens that are going to be listed on the future for the same amount of money that we've invested. So we basically got one investment, but we have three types of different assets, and we got three times worth of investment in terms of tokens and equity. So I think that was a really good deal. And there are different structures, and you have to go through it. And it's very interesting to go. We are talking to startups, and they're inventing something else, and they have this and that, and that's fascinating.
Wow, that sounds beautiful. So that means, of course, I'm just thinking off the top of my head. So as a founder, if I wanted to look really attractive, that could be one way to look really attractive, offering equity and also offering the chance to participate in the token in some way or form. I guess like that could be attractive to an investor.
Yeah, definitely. Of course, you should take into account that you cannot just fundraise. You cannot get token just for fundraise. It doesn't happen anymore because of the regulations. But you should have a solid utility for the token, and then if that is the case, it has a lot of demand. Community really wants it and use it, and then the price will go higher. And then, of course, this is a good opportunity for the investors. So, definitely.
Okay, that sounds good. That sounds really good. All right. I think we've come to the end of this podcast. I love like so much of what you've spoken about here. I think I'm definitely better educated. And but I don't have to be the only one that's better educated. I definitely know that you have a program that's meant to help more and more people to actually like get as educated on this topic and actually like get better primed for being better investors, better founders. And so I'd like you to talk about it, like how you actually do intend to help people actually become better at this, as good as probably you. So tell me about it.
Yeah, definitely.
Yeah.
Sure. We developed internal program to educate our own analysts, and then out of this we developed an external program because we had few cohorts of interns. So we're usually every cohort that we have the education, we hire a few interns. So let's say we have 20 people in this cohort, and then in the end of the cohort we would hire 3 people for interns, and then we would hire 1 person as a full-time. As it happened with the cohort number 2, for example, we have still a senior analyst who is working with us. But we also understood that there is a demand. People would like to switch to different roles, so they would like to have hands-on experience. So one thing is get educated. You can read a paper or something, but the other thing is when you get educated by people who are doing it as their business. And then this way you can also showcase it on your work. Like if you apply to the job and you say, hey, I have this specific case that I've been working on. I have my calculations, I did the internship. So it really makes a difference for a person. And for a startup, I think it's also very valuable to understand how investors are thinking, how they would like you to be presented, what things that are, they have their eye spot on, what things are not important. Like sometimes startups are just mentioning things, but they're just wasting time. Maybe they would need to spot on the business model and fully diluted valuation and execution of the token warrant, like all these specific details that would be much more interesting for the investor. So we're also talking about internal processes, how this is executed internally. So what steps are we doing? It comes to analyst is doing this. He goes through these criteria. He gives this score, and afterwards we give feedback to the startup. So we go through this all processes, and then it makes much easier for startups to fundraise after that. And of course, it's useful for investors because people would be more would have more structured approach. So it really structures that information nicely and neatly. So if you're curious about that, you're welcome to join. We'd be happy to see you and mentor you. We have packages with mentorship, or you can just watch the lectures. It's up to you.
Wow. Okay. That sounds beautiful. And if you're listening to this right now, I'm going to put a link wherever this is uploaded. This podcast is going to be available primarily on Spotify, Apple, and YouTube. And there's going to be details, like direct details to actually join. I suppose, of course, I am going to share a link, and whoever needs to sign up is going to be able to sign up and benefit from this. like Dima just said, you're going to get an internship and possibly even a job placement, and you're definitely going to have lots of amazing experiences to show for it. That's really going to serve your career going forward. Not just your career, definitely serve your understanding of investment, especially in this rapidly evolving space called Web3 or Web 3.0. Thank you so much, Dima. Thanks so much for sharing all of this knowledge. I'm definitely much smarter for it, and I definitely believe a lot of people are going to be smarter for it. If you're still here, I encourage you to go to the link in the description and sign up. There is nothing to lose. You can only get smarter from here, and you can only open a lot of new opportunities for yourself. So do that.
Yes,
And
definitely.
yeah, so do that. And I look forward to speaking with you on the very next episode. If you'd like to follow up with what Dima is up to and what 3X Capital team is up to, you can follow them on LinkedIn, or you can reach out to them via their website and their entire social media presence. For me, you can always find me. You can always Google Elvis Kolawole. You know where to find me everywhere. And if you're listening, I look forward to seeing you on the very next one. Till then, bye bye.
Thank you so much. Cheers.
Cheers.